Hi, welcome back to the ANS Way and our second financial video. The last video was based around liabilities and how I like to cover those off with easy money, or money that's working for itself. So what I'm going to do in this video is give you some view into how we try and do that, and part of the journey, although most of the journey will come in later videos. I want to start off by saying we are by no means doing amazingly well, but we are really proud of where we are financially, especially from where we've come from, which effectively is zero. All of our money has come via working, and we're quite proud of it. And the reason we want to share this with people is hopefully it can inspire somebody, hopefully it can give somebody some hope if they're starting out with nothing, and hopefully it can give you a little bit of an idea of how to go about and get into at least where we are. Let's get into this video. So what is it all about? Essentially what we try and do is have enough asset income to cover all of our liabilities. Now the difficulty in getting that is having enough capital in the first place to buy those assets to produce enough. And in later videos we'll get into how we really started that journey and how the nuts and bolts of it works. But for the purposes of this video, it's just going to be a high level overview of what we have and how much that produces and how much of our liabilities that cover before we have to dip into our actual paychecks or income to pay the rest of those off. What I will say is sometimes it's all about working, even if it's not a high salary, saving up until you can buy the asset. And sometimes it's about being really smart and efficient with money. So that's using LISAs, ISAs, any tax wrapper where you're protected from paying tax on the interest, using short-term low-cost loans to bridge gaps between if you know you've got money coming in 3, 6 months, a year, potentially using cheap interest to buy or pay off something that is a higher interest rate, but you know you're going to be able to afford it later on. There's lots of tips and tricks around doing this, especially when you're young, because the UK government in particular are really good at offering things like the Help to Buy scheme. Now you can use that massively to your advantage because you're offsetting a 20 or 40% of your mortgage interest, basically saying to the government, here, you pay for it while I save up the money that I would normally be paying for it. And usually because the mortgage is only 60% now, you're getting a much better interest rate on that loan. So it's really about working, producing an income, saving, and then being really smart once that ball is rolling. Right, so I'm going to give you a 5 or 6 year snapshot, so the last 5 or 6 years of our investments. And the reason I've picked the last 5 or 6 years is because that's when the ball really started rolling, and that's when the momentum picked up. There was 8 years before that of essentially groundworks and putting down foundation, but in actual fact we didn't really see much in terms of returns. The property that we owned didn't really have much equity in it. It was just grinding it out for the first 8 years, and we'll do videos on that as part of this series, but for the purpose of this, it's the previous 5 or 6 years. Starting with our non-employment based income, and we're not going to cover off employment based, this is just purely non-employment based, which is what we try and use as passive income to pay off our liabilities. So the first one is dividend income, which currently sits at about £210, £220 per month. And then we have property rental income, which I think is about £4,175 per month. And that gives us a total of around £4,835 per month of passive income. And the reason why I'm hesitant to say passive is I think it's banded around a lot, and passive, when I think about it literally, is kind of you do nothing. The money just sits there and it's produced automatically. In my opinion, there's not really such a thing, and especially when you've got property income, there's a lot that you have to do in terms of maintaining all of the legal stuff, maintaining the house, dealing with tenants, dealing with requests that come in from contractors and problems that come up. So I would say it's semi-passive income in that case. In terms of the investment income, I would say that's truly passive. You buy your stock, you leave it, money comes in. You'll remember from the previous video, there was an outgoing of 7,570. So you'll see that there's a deficit there of about 3,100 incoming to outgoings. This is mostly due to the new US rent. You'll see from our previous mortgages that we keep our mortgage is really low. Even in the houses that we live in, we don't overextend ourselves buying £1 million homes. We buy relatively cheap homes for the southeast at least, and we try and keep those costs down. Now here we've taken a leap, and it's something that we've really wanted to do, and we feel like we're treating ourselves a little bit. So that 2,500 is quite a lot, and that is the reason why you'll hear us talking about in the other videos buying another property out here. There's a lot around that, and we'll get into that in another video, but potentially we're not going to do that now. We've started looking at properties back home. We are looking again at investment properties here, but ultimately what we're trying to do is work out a way that we can take a lump sum of money and have that produce an income that covers that off. Remembering the entire goal here, primary goal, is to have the same income from passive, semi-passive as we have liability. So we want net zero effectively, and that's post-tax, which is a whole different topic, which we'll come on to slightly later in this video and then in a completely separate video. As a rule of thumb, for me, for us personally, and in our experience, I would say you get about 5 to 7% gross return on your investments. Now, where that can shoot way up, and which is the reason why I like it, is property. Because property is leveraged, you don't put in 100,000 and you only get 5 to 7% on that. Effectively, if you put 100,000 in and you've got a property that was worth, I don't know, let's say 400,000, you earn the return on that total amount. Now you're obviously paying interest and everything else, so that's why the gross return might be around 20%, and then after your interest and your taxes, which are very high in the UK, you're probably left up with a good 12%. 11 or 12% at the end of the year, which is why I really enjoy property. Now, the big problem with property is, yes, it's leveraged, but you need a lot of money up front. As an example, in the UK for buy-to-lets, you're going to need about 25% up front. You need to pay your standard stamp duty plus 3%. So if you already own a property, which most buy-to-let lenders want you to have, a UK property that you live in, you then have to pay an extra 3% on top of that. You've then got your solicitors' fees and all of the other associated costs that come into it. A straight example with one of the properties that we recently purchased, I think it ended up costing us about 80 or 90,000 pounds straight in. Now the rent is around £1,400 per month, but you have to have that money up front to be able to pay off the deposit and all of the fees. So it's one of my favourites, but it's also one of the most costly. Now, there are some really good tips and tricks, especially when you're starting out, in how to get around having that money up front. For example, if you use the Help to Buy scheme, you obviously lower the amount that you need to put in first. You cannot have a buy-to-let property with that Help to Buy scheme, but what you can do is save up enough money over 1 to 2 years and then refinance the home. You can refinance it for a higher rate providing the market's gone up, and effectively that money materializes. And we'll get into this in another video, but that's an example of how you can generate maybe an extra 10, 15, 20,000 pounds without actually having that money in your pocket. To round off this video, you've seen how much non-salaried income we produce. I'll give you a very brief rundown of the investment amounts that we have in order to produce that, just to give you an idea of how much you're going to need to produce that type of income. Our total amount invested is around £410,000. Now, did we invest that directly out of our pockets? Definitely not. A lot of that has come from appreciation, growth, refinancing. We've obviously had to contribute quite a lot to that, but that goes to show you that it doesn't have to come directly out of your pocket. Now, that is real cash, so if we were to liquidate everything at this point, that's how much we would get out of everything that we had. A lot of that capital growth came during the pandemic period, and I guess it was risky, even at the time, but also looking back, as the market started to crash, I took pretty much everything we had in cash and I began investing it into the markets. Now, this is exactly the same point that we had to move out of our home, and you can watch those videos, those ones done by Selena under Hills in Business, but we had given up our home to a family because we had agreed to. We were sitting in temporary accommodation and we were attempting to buy another apartment because we had no idea when we were going to reach Las Vegas. So I took all of that and I started investing into the markets against my friends and acquaintances' opinions, which was don't do it, the market's crashing, you're going to lose all of your money. However, in my view, no risk, no reward. And secondly, I remember a very famous person saying, be greedy when others are fearful. And that really stuck with me. And I'd only started reading about investing maybe a year and a half prior, but that's something that really stuck with me. When people are fleeing, everything is cheap. If companies were good value before that, they are doubly good value or triply good value now. So that stuck in my mind, and I took a lot and I invested it. High risk, but it's ended up paying off in that period. Now, you hear a lot of the sayings of the rich get richer. That is true, but I think it's because in some cases at least, they're more efficient with their money and a little bit more savvy. So I was just trying to follow that example. It's all a system to be worked. Now, we didn't overextend ourselves, so it wasn't anything we couldn't afford to have dropped to £1 for the next couple of years, but it was a lot of what we had, and thankfully it has paid off, at least until now. The last point I want to make before finishing up this video is, in stamp duty and land taxes alone, over the past 5 years we've paid about 44,000, and that's just your land duty that you have to pay every time you buy a home. And on average over the past 5 years, I think we've paid about £55,000+ in income tax. And the reason I'm making this point is, I appreciate it's not that easy for a lot of people to get into investments, into property, because a lot of your money just goes out to day-to-day stuff. Even when you start to earn more money though, the taxman takes a lot of that. And the important point is here, our tax bill won't be half, but it'll be reduced by about 30% of our total tax burden by living in Las Vegas. So in actual fact, coming here opens up another opportunity. And this again is just about being efficient with your money. I mean, Las Vegas suits us really well, so there is that. But move, if you're really trying to reach a financial goal and there's somewhere that's a lot more tax efficient, you may have to consider those moves. And it's all about the sacrifice, really, what you're prepared to do to get to your goals. And with that, thank you for watching. Hopefully you've enjoyed. Let me know how I've done. It's my second video, still a little nervy, but hopefully I've done okay, and I've covered off some of the things that people want to know about us and about how to invest. So thanks for watching, continue to subscribe. See ya.